You are listening to The Vocal Technologist. Spoken tech for your ears.
Welcome along. Today we're looking at some really interesting stuff, everything from what the big tech companies are doing with AI, right through to the nature of money itself, and maybe what actually makes a startup, successful.
Yeah, a lot to cover.
Definitely. And our aim really is just to pull out the important bits from all these different sources, give you the key insights, maybe a few surprising facts too, so you're properly clued in.
That's good.
Okay, let's start with AI. The competition there is just, well, fierce. And Meta seems to be making some particularly big moves.
Oh, absolutely. It's quite something when you look at the numbers. The sources mentioned Meta putting, I think it was $14.3 billion into scale AI.
Wow, billion.
Yeah, billion. And they were even considering potentially acquiring SSI for something like $32 billion.
That's staggering. Why such huge bets?
Well, apparently their Llama 4 AI didn't do so well on the benchmarks, ranked like 39th. So this seems really aggressive.
A bit disappointing for them, I guess.
You could say that. So they're reportedly throwing around these like 9-figure packages to tempt top AI researchers over. It feels very much like a Zuckerberg do whatever it takes approach.
Right, he doesn't want to get caught out like before, maybe with Apple controlling the platform.
Exactly. That costs them billions. So the thinking seems to be AI isn't just a thing, it's the thing.
Yeah.
It's how they own the next big platform, avoid being sort of a tenant on someone else's digital turf again.
Okay, so that's the huge corporate picture. But how does all this AI push change things for us? How we actually use this tech day to day? Is user engagement shifting?
Yeah, and this is where it gets really interesting, I think. We're seeing this idea of micro-moment analysis really taking off.
Micro-moment analysis.
Right. Basically, AI predicting those tiny split-second moments when you have a really specific intention. That I want to know something, or I want to go somewhere, or buy something right now.
Like quickly checking the weather or finding a coffee shop nearby.
Precisely those moments. And by delivering really relevant stuff right then, AI personalization is apparently getting conversion rates, get this, 341% higher than the old ways.
341%, that's huge.
It's massive. And it makes you think, right, if AI gets so good, it can basically predict our taste, figure out our patterns perfectly, what's left that's uniquely human, maybe just our agency, our actual will to act on our values, decide what matters beyond the predictions.
It's a bit unnerving, like will genuine spontaneity just disappear if everything's predicted? Okay, let's switch gears a bit. Moving from AI's impact to, well, the basics of finance, how does all this tech change affect how we think about money? Or even business success?
It definitely forces a rethink. One source flags a pretty serious warning from the bank for international settlements about stablecoins.
Stablecoins, right. What's the worry there?
They're concerned these stablecoins might fail what they call the singleness test of money, meaning they might not always trade one for one. Depending on who issues the coin, their creditworthiness, you might see different rates.
So not really stable then, like different brands of dollar almost?
Kind of, yeah, like quasi-dollars. They even use this phrase, stablecoin corporate feudalism.
The feudalism.
That sounds dramatic.
It paints a picture, doesn't it? Where you're sort of locked into one company's ecosystem, maybe paying fees just to swap between their token and another one.
So higher costs, less choice, stuck with one provider's digital cash.
Okay.
Yeah.
Not ideal for the user, potentially.
Got it. Okay, so from big finance to startups now, there's this really interesting, almost contrarian take on something lots of founders seem obsessed with, valuation.
Ah, yes, the valuation fixation.
Right, seen as the ultimate prize. But this source says, actually, it's a terrible scorecard.
Exactly. It argues valuation can be really misleading. It hides things like, how much equity early investors or employees actually end up with after dilution, or it ignores massive risks in just getting the thing built and running.
So chasing that big number can actually be bad.
It can create huge pressure, yeah. Makes startups focus on growth at any cost.
Right.
Maybe losing sight of actually building a solid, sustainable business. The advice is pretty clear. Focus on efficiency, keeping customers happy, and sticking around.
Retention, yeah.
Making real progress towards breaking even, and being realistic about what the equity payouts might actually look like down the line. That's the stuff that shows a healthy company, not just a flashy number on a, term sheet.
It's fascinating, isn't it, how both this super advanced AI stuff and rethinking basic financial ideas push us to question things we just assumed.
Yeah, the common thread seems to be looking beyond the surface, beyond the metrics that grab headlines.
Right, whether it's AI hype or startup valuations.
Exactly. It's about asking, what does this really mean? For us as individuals, for how markets work, for what genuine value actually looks like.
Absolutely. So maybe something for you to think about is this. What if the real way we measure progress isn't just the cool tech we can build, but how that tech forces us to properly reconsider what we value, what success really means, and maybe even what it means to be human as everything changes so fast around us?
You've been listening to The Vocal Technologist. Tune in next time.